Welcome everybody to today's meeting. So we're going to be going over some tax things, but we first of all just want to welcome everybody that is a client. We also want to welcome people who are guests. There's always usually some guests on here as well, and we want to welcome you. And also we'll be providing information today. And hey, I just want to tell you, we'll be talking a little bit about taxes and some information. But hey, before I get started, I just want to let you know, I'm George Thompson with Thompson Wealth Management. So we're a firm that help people achieve their financial goals and everything. So I'll be leading the presentation today, but we'll have a couple other people speaking as well. Also, I would say right to my left, but I don't know how your screens are all set up and everything like that. But we have Danette Wilkerson. She's a co-host today. So Danette.
Hello, everybody, and thank you for joining. I know most of the names, so I don't need to see your faces, but it's all good. Everybody's on video except Amadi. Hi, Amadi. And I'm looking forward to it. Today, Crystal is the co-host. So
it's the co-host. Okay. All right, I'm doing it. So hey, Crystal, how are you doing?
I am doing absolutely wonderful. It is nice to see everybody's face and see you guys here because this is an important topic. I want us to.
All right, good. So hey, just a couple of other little housekeeping things, and then we'll kind of go through them. So I'm George Thompson. Also, Danette is is also the VP here of everything, and then also Crystal that will also be speaking. Works also with Thompson Wealth Management, then also assists me at the church, Faithful Central, and then she helps with a lot of the areas of tax and these areas. So she'll also be on here. And then also our two comfort coordinators. Julianne is right here. So she'll also be assisting in these areas. So it'll be good. So if you have any questions, please type them in the chat. Raise your hand, let us know, because in a moment I'm going to put some slides up on the screen. So I may not be able to see them, but Danette will help answer some of those as well. And then our other co-host is co-comfort coordinator also is Shayna. So also later on, she'll also be able to, when you have questions, if they're very specific, then what happens is that she can keep them, and then we can call you back, find a little bit more information, be able to answer them in these areas. All right. Does that make sense, everybody? So here, let me just check and see how the screen is going. So now can you let me know, do you see, how's the screen look? Does it show everything on the screen, Danette?
It's all good.
Okay, it's all good. And then also, I think there's a few people in the waiting room, so I think you guys can let them in. So we'll do that. All right. So as I said earlier, is that we're going to be talking a little bit about taxes and things in that area. And so just a couple of things. So now, first of all, just going to put up, it says formalities and everything, but we just want to just let you know that we're going to be talking about finances, stocks, taxes, and everything like that. And I'm going to be giving examples today of different things, but there's not a one size fits all. These are all things that need to be talked about and a customized plan for you. There's not a single approach. We can just say, hey, everybody do this and this works. It all depends on different things, income, goals, and other areas. So I just want to make sure we do that. And then secondly, I will do my absolute best to answer all questions that you have. But if you ask me a very specific question about your finance, like should I do this tax-wise, it's very difficult to answer a specific question without knowing your whole financial picture. And then the people who are my clients, we need to discuss that personally, because privacy, I don't want to get into put all of your, I'm going to say this even though it's written, your business in the street, as they say. Okay. So I'll just let you know we can defer to that. And then the people who are guests, if you have any questions, I'll be more than happy to, Shayna and Julianne will set up a time for you to be able to sit down and us be able to go over that. All right. So I'll give you another moment just to look at this. And then we're going to go ahead and get started. All right. So next, can you guys also put yourselves, I already said this earlier because I think someone told me, hey, I'm going to be putting myself on mute. So, hey, can you put yourself on mute? Then two other things. Also, can you put your phones away or other distractions? I will not be talking long. So I just want to make sure we're locked in. Because, you know, in person, you guys know that if you ask me a question of something I just covered, you know how I kind of talk to you. So I want to make sure everyone is focused and what we're doing. So turn off everything except for unless someone is doing anything with a kid, you know, your kids or something like that. I totally understand that. So you guys know why I said that, because if my kids were in the room, you guys are going to see I'm going to get distracted. Cool. Questions. We enjoy questions. What's going to happen is I cannot see anything other than what's on the screen. So I'm going to pause every now and then and ask Danette if there are any questions. So what will happen is they'll be in the chat, or also Crystal. So I or Crystal will be able to answer them, but I'll pause a little bit during this. So we encourage the questions, and in doing that, amen. Okay, I'm gonna say everyone said, see someone I know typed amen in the chat. That's right. Oh, for some guests, I let you know I'm a pastor, so I may say that every now and then. So hey, let's go ahead and just get right into it. Hey, so you guys, just something just very interesting about taxes. I don't know if you guys know, but I just thought it'd be apropos for people just to kind of know how taxes and everything came about. Do you know that the first income tax was proposed in 1814 to fund the War of 1812? It happened, and listen to this. It is when President Lincoln signed the Tax Act. Didn't come until 1862. It was set for 3%. So look, incomes above 600 had to pay 5%. I'm sorry, they had to pay 3% and then 5% on incomes above $10,000. So look, the Act of 1800 also contributed to the Civil War. So look, following the war, it lost interest and then people wouldn't pay taxes. So it stopped until 1872. I'm sorry, 1872, they repealed the Tax Act, and then they didn't have it. So it wasn't until the 16th Amendment was ratified in 1913, giving Congress the authority to tax citizens' incomes. So you guys understand that they really didn't even want to have taxes. And then when they did, it started off very, very low. And just to let you know, I just want to give you guys statistics. In 2021, the US government collected, listen to this, $2.04 trillion in individual income taxes. Do you see that? Next. This shows you, by the way, what's called marginal tax rates. So marginal tax rate is if you make between this and this, you pay this. You know, different areas what you pay. So here are the marginal tax rates. So do you guys see in 1913 how that started? Then it started in 1915 and then 1915. Then you see these tax rates. So do you guys see where the highest marginal tax rate? That's 1945. You look, that's during World War II, 94% tax. Could you imagine that, taking home 6% of your income? Then now you see we're in 2022. It's 37, and the highest income tax bracket. I'm sorry, you saw in 2015 it was 39.6. Then you also see 37% as far as taxes. So now you kind of see what the marginal. That's the highest tax brackets. Now, I'd like to just share also this with you. And also, don't beat me up in the chat. I'm just telling you the information so that you know it. So we have what's called the progressive tax. So what the word progressive means is that the more money that you make in the system, or the more that you put in the system, the tax rates and your taxable income increases. So I don't know if you know these statistics. So, but anyway, if you didn't know, is that so the people that make over $200,000 per year of earned income, that's 5.7% of all returns, pay 62% of all federal taxes. So that is, I guess, you guys type in if you think that's middle class, but that is what the bulk of it is paid. Then if you see, there are 37% of all returns. That's people that claim or earn less, earned income is less than $30,000. That's less than 1%, paid 1% of all federal taxes. Then it says the people that earn more than 2 million, but below 5 million, paid 7.4% of all federal income taxes. So that just tells you about how our tax system works. So that's just something to kind of keep in mind. So let me tell you a little bit about now what I like to cover today, kind of walk through. So I'm going to talk to you about some changes that happened with tax laws. And then I'm going to just recap just different things in that area. Then I want to talk to you about Roth IRA, Roth. So anybody heard the term Roth IRA or IRA, Roth IRA? Then I want to talk to you a little bit about healthcare taxes, and then how we distribute money, and then just some ways of doing things. Smart asset allocation, Crystal, you'll be jumping here, and also gift tax, and then giving. Then I want to just have me and Crystal have a little bit of a conversation about just things people would want to know about filing and doing things with your taxes, because it's really about having a strategy. Does that make sense, everybody? All right. So here, let's get it going. So a couple of key tax rules that just so people kind of know them, just so you're clear, is in 2022, there's something called a standard deduction. For a joint person, a standard deduction means you're not itemizing your taxes, just making sure everybody kind of knows that. You're not itemizing your taxes. Right now, that is $25,900 for joint filers. Head of household is $19,400, and single filers is $12,950. So you understand that that's why you want to, if you're married, that's why married file jointly. So you see that $25,900. And then doing that. Also, the child tax credit increased to $3,600 for children ages 5 and under, and $3,000 for children 6 through 17. Then also another change is this. Do you guys know that limits on deducting mortgage interest, that means buying, building, or improving your home, have a maximum of $750,000 principal value. So you understand that that's the cap if you're writing down the interest on your home. All right. Now in the chat, guys, we'll be a little bit interactive. How many people knew what the standard deduction were, and then also knew that mortgage interest and deductibility? And by the way, people who don't live in California, is $750,000 is, there are mortgages over that in California in doing that. So that's something that was enacted that actually we're going to be talking about, because in 2017 they changed a lot with the tax code. So also a few more things to recap. There's something called a 529 plan. That's a college savings plan. It can be used for elementary and secondary education. We used to have this thing called college. You set up save for children to go to college. I don't know if you guys know, let me know in the chat if you know this. Do you guys know that there are elementary schools, middle schools, and private high schools that cost as much as going to college? They start at $15,000 and people paying $50,000, $60,000 a year. And some people have multiple children. So if you have a 529 plan, you can use that at an earlier, age. Also, which is, I don't understand this one. I mean, I understand why anybody would do this, but I just want to just state the facts. You can't reverse a Roth IRA conversion, but that's fine. I think people want to switch to Roth and doing that one. And then also it talks about state tax exemptions and different things like that. I want to make sure I get my numbers correct in that. But so if you look at that, there's just the alternative minimum tax is increased to $118,000. And then also the estate tax has increased to $11 million, $11.7 million. So there's an exemption that you have for estate tax. So that's also something you want to discuss with your tax professional. Now, the last thing I want to recap, just so people just understand, is that, as you remember, in 2017, they just changed the tax codes. So then they said, this is when something starts, and then this is the expiration date. So these individual tax brackets, I just wanted to say them. Do you see when they start, and then you see it when they sunset? The corporate tax rate cut, the large standard deduction, the repeal of personal exemption, and then the cap on state and local deduction, double tax credit. These are all the things that when they start, and then, oh, well, they already started, but then also when they sunset. Just real quick check-in. Does this make sense to everybody? Everybody remember when they came out with the new tax laws? Crystal, can you jump in here real quick? So, you know, like when they told people, it's about 2017, remember when they changed everything?
Mm-hmm.
So one of the things they changed, and I'm just trying to be as delicate and nice as I can, is that, do you guys remember you can't write stuff off the way that you used to?
Mm-hmm.
So what happens is this is when they happen. But now the Biden administration can come in here and adjust or change these provisions before they expire. But that would have them have to, you guys seen that I'm only a bill sitting on Capitol Hill. I'm sorry, for people under 40, there's this thing called Schoolhouse Rock. And what they do, and they say it has to go through committee, then it has to go through the House, Senate, you know, then it gets signed, okay? But these are all things that are tax-wise that can happen. But to the people who ask me questions all the time about our national deficit, is that money has to be brought in so we can balance the budget and then eventually reduce our debt. So, but these can be changed. All right. So
George, I'm
go
going
ahead,
to
yes.
jump in. So you guys, I want you to look at that second one that says corporate tax rate cut. We saw the largest tax rate cut happen to corporate America. And George, we didn't go back, that he had another slide there that showed how much people made and how much they paid in taxes, and that it was progressive.
Right.
That in and of itself has created a deficit for us. But what I want us to understand as non-corporations is that it affects us. And so you need to be on top of it and understand that every time a tax bill is presented, every time that it's passed, 9 times out of 10, it's going to affect you and what you pay. And that's why we saw those who earn over 200,000, they're paying 64% of the tax,
Right.
which is not fair.
Okay, okay. And that's okay. No, that's why we have you on to say this. So a couple of things, you guys, I want you guys to always remember this. This is number one thing I want you to remember. Every time you make a financial decision, it typically has a tax implication. I'll repeat it again. Every time you make a financial decision, it makes a tax implication. Now, while Danette's on mute, I'll start with this. Relationships. If you marry somebody, that has a financial implication. I did it while she was on mute because she always jumped. Don't say that. Okay, so anyway, it has that. Kids, LaRonda, Flowers. Do kids have a financial implication? Do they or do they not? Yes, they do. Okay, all right. Everybody has kids, know that. So every time you make decisions, they have financial, but you want to have them towards your benefit. If you look at the last administration, one of the things they really pushed was opening and having your own business. So you're seeing all this corporate tax rate cuts, all these things. Those are all built for that. Okay, I'll come back to that and hit those during our part where me and Crystal are going to talk about some of these things. But I'll come back to some of those. I want to make sure that we hit them. But you guys, 529 plans. I'm going to say this again later on when I get into options for you guys to do. You want to fund that. 529 is like, I'm sorry, I said a college savings plan. I'm sorry, it's not. It's a school. Everybody say school. It's a school savings plan. It can be elementary, middle, high school, and college or trade and doing that. So I think they're going to stop that, and also they're going to stop Ross one day and doing that. So, hey, I just want to also just go over this, and then Crystal, just jump in anytime you want to add any color, and then also you guys check in with us on the chat. At least, hey, look, I better get at least 3 amens. You guys, we said the part earlier about that in the part, but You guys, this is what's called capital gains. So everyone knows that if you buy a stock at this price, or you buy an investment at this price, let's say 30 and it goes to 50, that's a 20 gain. It's called a capital gain. Long-term capital gain means longer than 12 months. So you see these rates, 15% and 20%, those are also in your favor. So then that means you may buy or sell or make a financial decision on what you're going to do, also based on the taxes of what you'd have to pay for that. Hope that made sense. That made sense, hopefully, everybody, right? So this is based on income if you're joint, and then this is if you're filing single. And this is what the tax rate would be.
Add some color to that, because what most people do not know is that you can avoid capital gains by donating your stocks. Are we getting into that?
Yes, I'm going to get that at about 10 slides. Okay, gotcha. I probably don't come back. I'm probably going to come back to that because you guys, we really want to do that. Okay, but I'm setting it up. You guys, I'm setting it up though. That's good, Crystal. I appreciate that. It is so another way. So we're going to talk about that and donating, but also another way, everybody, is that you want to begin, and we want to make sure everyone that is a client, and then also if you're here for the first time, we always want to look at a way of you doing things in a tax advantaged way. So I'm just letting you know right now, the number one way is to have a form of a IRA. You want to have an IRA, listen to these, IRA, 401k. If you work for a nonprofit, a 403b, they might have it if you work for a government agency, a thrift to savings plan. Also, if you work for a county or a government, they'll say 457. If you're tired of all those numbers, there's something called an IRA. An IRA stands for individual retirement account. You want to fully fund them. They take out, other than IRA, they take out of your paycheck on a pre-tax basis before you pay state and federal taxes. So that doesn't, so like, let me give you an example. If you take out $150 out of your out of your paycheck, it wouldn't affect you $150 because you wouldn't pay the state and federal taxes. Your paycheck may only change by 120 or 130 or 100, depending on your tax bracket and what you claim as far as exemptions and things like that. Those factors would show you how much you take out. So I first of all would like to just show you, and let me show you why I show you this slide. You see here it says you can contribute $20,500 is people say in the 401k, I only put in what they match. If they match 3%, I'm only going to put in 3%. That's not how you should look at it. You should be able to put in the max or as much as you can put into it, because you can't go to a grocery store later. You guys know I'm about to eat this up with this now, with all the inflation we have now, is that you understand you can't go to a grocery store 20 years from now and say, hey, can you lower the price of food? I only save 3%. So you want to make sure that you're saving as most as you can, because there's two mean guys outside of your house right now. One guy is called taxes, which we're talking about today. The other guy is inflation. And we've never had to talk about inflation the way we do now. Inflation is high. It is right now. I mean, you guys know it is. I mean, I went to the, people at the gas station making life and death decisions, right? They're like, should I eat lunch? Should I get gas? So, or there's people that say, I'm only going to put, what's your guys' gas situation feeling right now? There's people that say, I'm only going to put in $50. I'm like, oh, well, you must be going every other day then. Okay, then, or that's what you must be doing. That, thinking it's going to go down. Now, again, if you're an investor, you say, let's just fill up right now, because we don't know what's going to happen in the future. But you guys understand, inflation is serious. So we have to have a plan for that. But we also have a plan. That's by investing, and we also have a plan for taxes, and that's investing. So sorry, it went down. So the 401k is, everyone should have that on their job, and we'll double check that with you. But you should be putting the absolute maximum you can into that. All right. Then there's something called a catch-up contribution. If you are over age 50, that you can catch up. That means instead of $20,500, then you can put in another $6,500, bringing you to $27,000 that you can put into your IRA, that you can put into your 401k in doing that. Then also your IRA, you can put in $7,000 to catch up and to do that. So you want to max out. Did I say max out? Max out on those. Okay. I'm gonna move a little bit quicker so we can do this. So everyone, there's phase out limits and everything depending on your and also depending on your tax brackets and different things like that. So we'll also cover that, depends on the individual basis. But also Roth IRA. Oh my goodness, we're gonna talk about Roths now. All right, you guys, first of all, retirement plans. There's two kinds. There's pay me now, or I'm sorry, pay taxes now or pay taxes later. If you put money into a traditional IRA, a traditional 401k, things like that, you receive a tax deduction, okay? Thus lowering your marginal tax rate. If you put money in a Roth, I'm gonna say this twice, you put money in a Roth, you don't get a tax deduction. It gets to grow and get taken out tax-free. So which one, but hey, Pastor George, which one should I do? It depends. If your income is really high now, you want to do a traditional one. But if it's lower now and you think you'll make more in the future, you want to do Roth because it can grow. So it can grow. I'm going to show you this conversion, but also I want Danette to remind me later on to say, I'm also bringing on another tax professional, and we're going to be having a live video where he's going to talk about opening up these and opening up businesses and different things, and for you and for your kids and hiring them. But that's something we'll cover a little bit of that when me and Crystal talk a little bit later on. But first of all, I want you to first understand what a Roth IRA is and what a traditional IRA is. All right. Everybody clear on that? Good. So there's something called a Roth conversion. So this is something to consider, is that you have, you're working somewhere and you rolled it over to a traditional IRA, and maybe you're not working there anymore, is you could convert it to a Roth. That means you pay all the taxes. But this is why what we want to work with you on, not converting all of it all at once and paying all those taxes, us strategically working with you to find out how to get the lowest, how do I say this, to be at the top of the bottom of the marginal tax rate so that you're not paying more taxes. I'll say it one more time, and then if it doesn't make sense, we have to show you based on what your income is and what you report for your taxes. Is we want to be at the top of the bottom of the next highest one. So like if someone's paying 25 here and it jumps to 35, 32, then we want to be right here at the top of the 25. That makes sense? If that, just give me a thumbs up or emoji if that makes sense to you. But we convert that and we keep doing that based on that time. And the advantage of a Roth IRA is this: there's no required minimum distribution. I'm sorry, no required minimum withdrawals. Anyway, there's something when you return age 70 and a half, there's something called the RMD. Shannon, what does that stand for? That stands for required minimum distribution. So in doing that one, also it's part of your strategy for that. And then number 4, it says Roth maybe just. I don't think Roth IRAs are going to last long. This is George Thompson's personal opinion. I think 529s and Roths are going to be stopped. Do you know why I think that? Does anybody know why I think that? Crystal, you know why I think that? I think it's too good of a deal. I just think they're going to stop it because they're saying like, we need that money. Because I'm going to say it one more time to you, and I don't know why I'm picking on Miranda. But let's say you have children, right? And then they put money in something at 10 grand and they're young, under 18 years old. And then in a Roth IRA, and it grows over time. They put in all their lives at a young age, and it grows to 6 figures or $1 million, whatever it grows to. They can take it out tax-free. I mean, just
gonna want his money.
You see, Crystal,
that's why it's not gonna last.
It's not gonna last. Your least favorite uncle, Uncle Sam, is gonna come in there and take that money. You guys, it's too good of a deal. I'll talk about this a little bit later, but I'm gonna do a whole show that I'll let you guys know to do it on opening, I'm gonna say it one more time, the number, opening a business, or you having a business, like maybe real estate, you do stuff, and then you hire your children and then start funding their retirements. Because I think the whole Social Security system, you guys, let me know, do you guys think the Social Security system, anybody under, let's start this, anybody under 40, does anybody under 40 think they're gonna get Social Security? Okay, just let us know what you think about that. Then, I'm sorry, if you're not over 40, if you're over 40, tell me if you think the people under 40 are going to get it. Okay, got it. Now, and then if you're 40 or 50, do you think you're going to get it all along, or do you think you're going to be 75 or something? Okay, we'll do a little polls, or just what you think, just just on that, because I think that's going to be a long one. But here, I want to slide through here a little bit quicker. Okay, gotcha. Then healthcare. I'm just gonna hit this real. I'm gonna hit some of these just real quick. Do you guys? I didn't know if people knew about healthcare. Just certain. These are certain things to look at when you're talking to your tax professionals and everything. Do you guys know that there is a taxes on your healthcare? Okay, additional Medicare tax, and these different areas that you actually want to begin to look at, and then when your income exceeds $250,000, there's different tax rates. There's different times when they tax you at this area, but it's actually 3.8 can be your Medicare tax on investment income. So we want to, but we want to talk about managing that. But we just want to let you know. I think, but people know there are those taxes, right? And then if you have, and then Crystal, you can add any color to this if you want to, is that if your medical expenses exceed 7.5% of your adjusted gross income, there are certain deductions that you can deduce.
And you guys, that sometimes is a deduction that's overlooked. And what I tell people is that if you plan on having dental procedures, medical procedures, try and do that in all that stuff in a calendar year so that it will exceed that 7.5%. But you can bundle them the following year. The thing is that if you get audited, you have to remember that you bundled them for that year and make sure that you have your receipts that are required when you go to that audit.
Say I got the receipts. Somebody should have said I got the receipts when they said that. I mean, come on, y'all. You guys ever been on Judge Judy? Oh, okay, good. Okay, but if you were, not to go. Don't go down to Judge Judy and not have your receipt, because she's going to call you all kinds of names, and then you're going to lose the case. But I think you win. I think you win in the end. But I think they give you the money at the end. But you're going to be embarrassed. Your family going to call them and say, she didn't bring the receipt. So but we keep all our receipts anyway, and then in doing that, but we just want to make sure you don't miss stuff, because sometimes people just clicking buttons on the computer doing it. So hey, now we're going to go over distribution. So hey, one of the things is some people say to us, hey, we're getting ready to retire. I'm getting ready to retire. What do I do? So I want to hit some of the things. So number one, we do all this for you clients, but I want to make sure people that aren't, is this: take an inventory from all of your retirement income. And then you review the tax treatment. Shane, I need you to come off mute. And Julianne, consider adjusting your asset allocation. And also there's something called RMD, required minimum distribution, and manage your tax situation. So you guys, you take an inventory of that. So to all of our clients, we build something when you're a client, and we call it a wealth notebook. Isn't that right, Shayna?
Correct.
So what we do is we look at all of your income, all of your assets, and we have it all on our program. And it shows all of your assets, then it shows all of your income, then it shows all your regular income. The next column would be when you retire, Social Security and all your sources of income, A and B, because we want you to have multiple sources of income. We show all of your expenses, and then we show how much you have at the end of the year, and we scrap it out for the rest of the year. And then we can also calculate in growth, investment. We run a calculation on what we think it can grow, and then we also calculate inflation and your investment, and then also rate of return. If you don't have that and you are considering retiring, you want to make sure that you do that. So make sure you set an appointment at a time. But you guys, to all of our clients, we already do this for you. We just want to make sure that you are cognizant of it, because you remember with your RMDs, required minimum distribution, we may look at all of your assets and say, let's take all of it out of this particular investment, but it's all based on how much you need. All right. Any color anybody want to add to this? Danette, Shayna, or Crystal about the Wealth Notebook?
Nope, it's
Cool.
it's a wonderful thing. So
All right, then since this, I'm going to go through these other ones then really quickly, because that they're just really simple. Smart asset allocation, tax smart. We already, I just told you, we have a wealth notebook. But the people who are not our client, just visiting or doing this, I guess, is that you have to look at your assets. There's assets that are not taxable. I'm sorry, not taxable. Sorry, that are in not tax deferred accounts. And there are ones that are in taxable accounts. You have to kind of put them all together and then develop a strategy. You can call us. We'll be more than happy to do that. All right, gift tax. Okay, so let's talk about this right now. Okay, and then about gift tax. All right, so that the amount of 16,000. There's people out there that say, I'm going to wait until someone passes away to give someone a gift. When I pass, they're going to do this. So now, before I start the soapbox, all right, get the violin ready, play the music, get the keyboard ready, Danette, is this. I have said for a very long time, so I just want to make sure we're clear. People shouldn't be buying all these Christmas gifts. I'm talking about G.I. Joe with the Kung Fu grip. What have I said? Everybody type in the chat. What have I said from day one to everybody? You should be buying stock for kids, for Christmas and for birthdays. All right. Okay. And then say that kid, okay, are you an auntie or uncle? That shut all that down. Because I mean, they're just toys. Kids are doing just fine. All right. I'm only gonna do one story and then then that can stop the keyboard. I was this is before the pandemic. So who am I picking up? Veranda. I was called and my daughter came home and said, they're down at the Grove and they're going to have an American Girl party at 1 o'clock. And then we're going to go to the Cheesecake Factory. I said, what time are you going to the Cheesecake Factory? They said 3. I said, I'm going to be there at 2:45. Because an American Girl, so you guys know, is they make these dolls, and does anybody know, type in the price of what you guys think. But there's dolls that are like $400, $500, $600. So I had Gracie come in and sit down, my daughter, and say, I'm going to buy you stock in Mattel. And then we're going to show up. And then I told her, I said, then we're going to show up at 2:45 and we're going to eat. And then you can tell all of them about how you own the company that they're all buying them. And thank them for their dividends. So before, wait, don't hang up. Don't call Child Protective Services on me. They already know me. Okay, because they know when they come over here, this is what I'm gonna tell them. I love my family so much that I'm trying to build wealth for them and do generational wealth. Start gifting now and use that for taxes, because you guys remember, do you know what I heard? Didn't someone say before this started that every time that you do something, make a financial decision, it has a tax implication. So you understand that. You guys already know that when my son came down and asked me to buy him some Robux. Can you guys believe that? How do you believe? He actually asked me to buy something. He asked me to buy something, use real money to buy something fake. And I had to let him know we don't do that. That's not how we allocate our assets. So I told him, let's buy the company. You guys understand that? So now gifting. What should we be doing is gifting. Start gifting stocks, start gifting things and giving them in that manner. That makes sense, everybody? All right, now, Crystal said earlier that you can also gift stock or give things to organizations. So now, can everybody, just someone type in the chat, 3 companies that just did good. that you think that it'd be a stock to give somebody or an organization. So I'm just going to say let's say you bought a stock of a company. Okay. Now I'm just using Apple. And by the way, Kelly wrote in Apple. Okay. So, hey, Kelly, you know something funny? I went down to the grocery store one day and I wrote down, see how you wrote in Apple? Okay. All right. No, you funny. Okay. But now it took before I was saying that. APL. So I wrote down their stock symbol on a piece of paper, for Apple. And then my wife, I was writing the grocery list and I was writing the stock symbols. And my wife said, George, you spell Apple like Apple, the stock symbol. And I said, yeah, because, we always review it when we're going down there. I said, if they learn how to misspell Apple like that, they'll be doing just fine in life. Let's say you bought Apple stock or you had bought that. And let's say the stock you had invested, I'm just using 10,000 and it went up to 20,000 and you had 100 shares. You could take and donate 50 of those shares to your church. I'm sorry, I'm biased. To your church or organization and receive a $10,000 deduction. Did you see what I just said? You bought it 10,000, you sold it. You didn't sell anything. Sorry, you donated that. You'd receive a $10,000 deduction from your taxes because it's the value. So that's how that would be a tax savings. Crystal, anything you want to add to that?
No, but you definitely want to always, this is all about tax strategies, you guys.
Right.
We want to be able to pay the least, I want you to be able to pay the least amount of tax, because I think what you can do better with your money than what the federal government can do with it. That's my personal opinion. So the goal is to do as much legal deductions and plan and strategize, and don't wait till the bill comes at the end of the year, but to have something in place ahead of time. And George has said it 20 times, if not more, on this call, and I'm exaggerating, but that most things are going to have a tax consequence. So before you go out and make decisions on things, you need to consult, particularly if you're a client. You definitely need to give us a call and let us know what it is so that we can determine the best strategy to use to keep you from having to pay as much tax. There's so many things that you can do. You can split it. Do one, I spoke about it before, about, healthcare or dental care procedures. You can take a lump sum in 1 year and do it that way. There's something that we didn't discuss and we won't get into, but I just want to put these things on your mind, called a flexible spending account.
Oh, my goodness. Yeah, right.
Where you can have pre-tax dollars placed into this account and you don't pay taxes on it, but yet it goes toward your healthcare expenses or your, it can go toward your co-payments. If you have, I can't even think of the name, it escapes me now, but where you pay for your pharmacy things. Prescriptions. Thank you, Lord. I didn't know why I couldn't get that in my head. But yes, to pay.
Hey, don't worry, I got a prescription for that.
Yes, and they have one for that too. I know, memory loss, huh? But those are things that you can utilize. And for those individuals who are young, they have a health savings account where if you have high deductible insurance right now, you're penalized from the federal government and the state government for not having health insurance. So that could help pay the cost for your health care insurance, which would be a HSA account. So I just want you to take the time to definitely, our time is running out, but to take the time to sit down and strategize and not be caught behind the 8 ball with a tax bill. Because everybody has the opportunity to somehow, some way, reduce their taxes. And George, I don't know if we're going to get into if we are actually going to get into withholdings and that kind of stuff, and people understanding that they need to be checking that every year. Do you want me to touch on that now?
Yes. So those are the questions. I want to now just tell everybody this is my second to last slide. Is now we're talking about So giving appreciated assets, we talked about that to a charity, but yes. So Crystal, I have those. So I wrote, we have questions that we have, and I'm going to answer these and then go to the net for the ones that are written. So just a crash course. What do people do about withholdings? How does that work? Or what do you do with your salary, or how do people know what to do for withholding?
So if you are a employee, meaning that your money is coming from someone who's paying you, not as a contractor, but as an employee, and taxes are being taken out of your check, you should make it a habit of a minimum of twice a year going in and double checking to ensure that you are paying the correct amount of tax on your money. And there's a calculator right there on the IRS website that you can go to, that you will take you want to make sure you have your last paycheck stub, because you're going to put that information in there, and those deductions, and it will tell you how much at the end of the year, based on what you're being paid, that you're going to owe in taxes. That is the easiest way to ensure that you do not end up owing Uncle Sam at the end of the year.
Right.
Another time,
I'm sorry to jump in here real quick. But people that are in our Shane, if you could pull this up at the end, people that are in our financial plans, we do this with you, and we budget monthly to make sure everything fits along with your mortgage and all of the other things as well. I'm sorry, but go ahead. And so if you're just visiting with us, or you wish to go to the IRS website and find your way around there yourself, you go right ahead. Go ahead, Crystal.
But you know what though, George, I want our clients to go in because I want them to be informed. I want them to be knowledgeable. Yeah. We'll go through it with you. And the first time it might be difficult, and we definitely will, without question. If you're a client, we'll go through it with you. But I want you guys to go and do it yourself so that you can see, because that empowerment and understanding and knowing. Tax laws change. Everybody, I saw many questions in here. Well, what about this? Well, what about that? Well, truth be told, tax law can change tomorrow.
Yep. Right.
So we can't, although we strategize and we try and plan, there can be some hiccups to where something changes. So that's another reason why you want to have an advisor and be able to come to us, like a team like us, to be able to plan for that, because we try and stay on top of things. And even as much as we do, sometimes some things happen that we're not aware of.
Right. And one thing really good about that, though, is this: when things change, you guys remember, like markets, how things change, we want to use it to an advantage. You know what I mean? Like, hey, they changed this. Hey, let's do that. You know what I mean? Like, so that's why we taught people about opening up corporations or opening up business. Like, we like to change with them. That's a really good point, Crystal. I'm sorry, go ahead. And then I got a small business question for you next.
Is our we call them 1099ers, those people who are paid as contractors. Taxes are not taken out of your pay. So therefore you are responsible. In so many instances, I see people wait until October, because they get an extension.
No, okay, go ahead. I'm sorry. Go ahead. I'm gonna listen. Go ahead.
They wait until October, and then you're charged not only a penalty, but you're charged interest. Our 1099ers are employees, or I'm sorry, our contractors who are paid that do not have taxes taken out of your check. You guys, you need to be paying your taxes quarterly. There is, again, another thing right there on the IRS website, or if you are a client, we can go through that with you. That will tell you your estimated tax that you owe based on the last 3 months of income that you received. And there's 4 times you should be paying your quarterly income tax to the IRS. And the penalties are ridiculous. So take advantage of strategizing and doing these things in advance, and not waiting until October to get them done, or even April 15th to get them done.
All right. No, that's good. That's good. I'm sorry. Thank you. That's really good. But also, guys, 1099, we got something we want to, if you own your own business, you guys, it's strategy. So we want to make sure that you're planning and we're doing stuff earlier than that. In that area. So, because we're going to talk even deeper about that on another day. But hey, can you also tell us anything else, just things about planning? Because we're getting people asking about LLCs and should I do this if I'm buying? What should I do if I'm buying property, selling property? What do you want to say anything about that tax wise or I'm gonna let you handle it today and retirement. Go ahead, tell them. You tell them. So
Well,
tired of me telling them.
most definitely. So you open up, you expand your horizon when you have a business, whether it's a home-based business, whether it's an LLC, S Corp, C Corp. So, and we're not getting into the specifics of those or which one you should have, which one you shouldn't have on this particular call, but it does allow you to have more deductions. But I need everyone to understand too, because sometimes we just don't know. The standard deduction, and George said it at the beginning of this call, has gone up, and it's up to $12,550. So that's pretty substantial, you guys. That's automatic. That's the standard deduction. You don't have to do anything to get that. But the flip side of that is itemized deductions.
Right.
With a business, you can itemize. Itemization means that you can take so many more deductions that you cannot take, that you will not get as a standard deduction. But understand that it has to be over that $12,550. So you need to, that's something that I find when I talk to clients, they don't get it. They want to itemize, and they think that they can do the standard deduction plus the itemization. That's not how the IRS works. Get one or the other. You don't end up getting both.
Right.
So that's one thing that I wanted to discuss, George, about standard versus.
Right. And the difference is in itemization, just so you guys know, when she said they raised the standard deduction, but they took away a lot of the write-offs, is what you saw. So the advantage is moving to a business, and we do whole calls on that. But the most important thing we want to make sure we say today is that you have a strategy. So now I'd like to go to Danette, and Danette, if you would ask some of the questions that are in the chat, and I just want to say this, I said at the very beginning, I'm gonna say it now. If your question is very specific about your tax situation, without us looking at your taxes and doing it and having a tax professional. So we have Crystal that helps us with them on this level. Then there's also, we work with another gentleman in the area. We have a team of also people that work in the area of tax that we also work with if they're running a business or they're more complicated in that area. Danette, questions?
Okay. So I saw that a lot of the questions earlier were specific, and Julianne and Crystal took care of those. So thank you very much. Then right before I was already about to ask the written questions, 3 more came in. So you guys, Crystal and George, if you want to look at those and touch on those in a second, but let me get to the written ones first. One of the questions that was written in, you kind of covered, and it was, how do you figure out how many exemptions to claim to maximize income? Crystal, is that the tax calculator you mentioned in the IRS? Or when someone's taking a number of exemptions on their return, how do they figure that out?
So if they're a client, we just need to do a tax strategy appointment, and I'll sit in with them, because it's specific to each individual. So to make a blanketed statement wouldn't be fair to anybody. So I would want to sit down with them and have a tax strategy and a tax planning meeting with them. But that is a start if you are a employee.
We want to find out to help you get more deductions. So one more thing real quick, and then I want you to go rest up. If you receive a W-2 and you don't own a home and you don't have you don't have anything to write up or anything like that, then that's fine. Then that's just real simple. But if you have any of them other things, right? Rhonda, you got kids, houses, things like that, other blessings, then you need to, see how I said blessing? Then that's where we have to develop that strategy, okay? Did I say it? Everybody, can I get a thumbs up if I'm being nice? You guys remember, I'm never withholding that. I'm just like, but I don't know how to answer that without knowing something. Like someone says, hey, George, should I buy, someone said Apple stock. Should I buy Apple stock? Well, how much money do you have? How much do you have to put into it? Have you ever bought a stock? You know what I mean? Like there's just a couple questions I have in doing it. Danette, your second question, go ahead.
So in essence, the general answer I would say is that, there's a number of exemptions you can take on your return. Crystal would need to sit down with you to decide if it's 0 to however many. How many can you take, Crystal? What's the max exemptions?
And not be in jail. Everybody.
Well,
Go to jail.
and not go to jail. Well, for a business, there's about 266, I think it is 56, something like that. Don't quote me on it, that you can take as a small business owner. And as an individual, if, like George said, you're just a W-2, your standard deduction is about all that it is that you're going to get if you don't have any other thing at all.
What we're talking about is, how when you fill out your W-9,
Kind of 1 through 9, you're saying that way.
1 through 10 or 1 through, you could take a certain number of on your, so that they're taking how many do you?
That has changed. You can no longer do individual deductions like that. That whole form has changed. As a matter of fact, maybe we need to send that to everybody so they can see it. No longer take the deductions of saying like, I have 3 kids, I have a husband, I have this, and then it calculates this number that no longer exists.
Wow.
I'm glad you're here. I'm glad you guys are here to that. I'm sorry, I'm an itemizer, so I don't.
That no longer exists. So when you say, so you're talking about in advance. So the questions that they ask you now is head of household. Do you happen to have someone that you can claim so that you can be head of household? Are you married? Are you single?
Right. No, I'm about your job, the form that you have to fill out initially so that they take that out, because you don't fill that out every year. You only fill it out the one time.
So
how do they know how much taxes to take out?
I'm telling you how they know it. You either state that you're head of household, you're married, or you're single.
Okay.
Don't get that number anymore. Remember, I know that's what you're referring to, and that's probably what people think, that you used to say, oh, I have 10 dependents. So then the least amount of tax would be taken from your paycheck. That's no longer. You either can only do head of household, single, or married. And then they have a line item where you can add more money to be withdrawn from your check to go to the IRS.
Okay. So all these questions they can ask you directly when they come in with you, because most people only fill that out once and they don't fill it out again. But get to
and then it's so funny is then you do that is that I'm glad we're having this, because then it's just mindset of us talking, and even though I think the more those you put on, the more you get on a list to be audited. That's what I think. But I mean, that's just me. But now they don't have that anymore. So that's funny.
No exempt either. You can no longer do exempt. I remember when I was a student, I won't date myself, but when I was a student, you could say, oh, I'm exempt from taxes. Uncle Sam no longer allows exemption.
Wow.
As a matter of fact, they're going to send you a letter if for some reason the taxes aren't being taken out. They're going to send you a letter saying, hey.
For hell, right.
Let me get to the other ones.
Get the other question. That's good. Whoever asked that question, I'm glad you're here. That's a really good question. Go ahead.
So then, cryptocurrency, Crystal. Questions asking, I just began investing in the stock market and cryptocurrency. I had my fair share wins and losses. Should I use a CPA or will I be okay with TurboTax? Or should they call you?
Then I have an answer for that as well. Go ahead.
If they are a client, definitely need to review it. TurboTax is okay as long as you know what you're doing. But let me tell you what I find people have the tendency to do. Change the answers, right? Instead of being truthful, they just change it. Okay, well, what if I had a loss of $5,000 with my cryptocurrency? Because now you guys, you have to report gains and losses for cryptocurrency. Nothing is going to get by Uncle Sam for long, okay? He is not going to allow you to make money and not get a piece of it some way. So you have to answer those questions honestly. And if you have a situation to where you're dealing with estate taxes in any way, anyone who passed away, those things I don't think you should utilize TurboTax for. If you're doing something simple, like George said before, you're a single filer, you're going to do a standard deduction, by all means, go ahead and do that. That's probably your best bet, and it's going to be the least expensive route also. But if you have a home, if you have a business, I think you should go to a professional and someone who understands it. There's some things that I don't even do because you need specialization in that area. If you're in the entertainment industry, there are so many more deductions that you can take that I'm not familiar with, but a person who's a CPA or a tax preparer in that area knows. Yes, okay, you can take your spray paint gun for makeup. I don't know what they call it, you guys, but whatever that is, oh yeah, we can deduct that. Okay, or we'll do that as a 179 deduction instead of doing it over 7 years. So those type of things you want to see a professional for if you're doing business taxes or something other than your standard tax return.
Right. Hey, one thing about it, then we have the other ones because we're going to run, because we have 4 minutes to finish these. One other thing though about crypto, and then I'll ask you guys if it's okay if you guys want to go a little longer, is this. So number one about cryptos, we interviewed the Securities and Exchange Commission. I had an interview and about regulation, different things. And also talk to another, I'm also going to have an interview with another tax professional where we go deep into this thing. And they may start having attestations that would have to say whether or not you have these cryptocurrencies. So what happens is if you say, because some people report them, some of these platforms report them and some of them don't. So you'll see, so if you don't hold the money, they may come back later and charge you for it. You notice people walk around saying they made $1 million. You'll say, okay, cool. Well, where's the couple $100,000? So, and to whoever wrote on here, suppose I never touched the money. I don't know what that means, because if you sold it and it was a gain or bought something else or how you ever did that, it's still a capital gain based on you, whether it's a currency or, it's a capital gain. Danette?
Yeah, I mean, we have a lot. Do you want to check in and see if everybody wants to go over and do your closing? And then if they do, gotcha. I can grab questions.
No problem. You can grab those. Let's do a few more. Everybody's okay. You guys okay to hear a few more questions? Hey, we'll do that, and then we'll do that. Let me know if that's okay, guys. So I'll do that for another 5 minutes. Then I'll do a close, and then we'll hang on for just another few minutes and do it. But I just want to make sure we're being on people's time when we say we're having these, so that you're doing it. But it's your questions, and we're trying to answer them for you because we want you to have the answers. Go ahead.
And every told them I don't even tell them how long it is anymore. I used to say for
okay, then go right ahead then.
I don't think I did, but it's possible. But anyway, we want to be respectful. An hour is a good quality time. So then this one it's almost personal, but it's a general question. Suppose a couple sells a house together, Crystal, and then they file their taxes separate. How should they be doing that? Is that normal? And what's the tax implication of that? Or is that a question you would never answer unless you know exactly what it is they're talking about?
Well, this I want
capital gains.
Are they married?
They're married, and they sold the house together, but they file their taxes separately.
Okay, see, you're already at it. That's why you need to speak to a tax professional. You are already at a disadvantage if you are married and filing separate. You are exempting yourself from many tax benefits by filing married but separate. So I'm going to leave it at that, and then we need to understand their particular situation. I can only think of a couple of situations why you would be married and filing separate. One would actually be you're separated. You're actually not together, and you have a legal separation stating that you're not together.
And then also, Crystal, thank you. And everybody, one of the reasons why we like to talk to you a little bit is that I know you sold it and you're done, is that talking to us beforehand so we can kind of develop a strategy, like saying like, hey, are we buying another property? Hey, are we doing this? Is someone buying one? And then if we're separating, are we buying two separate ones? Is there another way of us doing that? You know what I mean? Like, so we can develop a strategy a little bit before that and then kind of get that going in that area. So it'd be good to talk to you. That was good. Anything else you want to add to that one, Crystal? If not, to that
No,
next
sir,
question.
you said that one very well. So you develop the strategy. And the thing is, guys, don't let it be an afterthought, particularly if you're a client. Please don't let us be an afterthought. We preach and teach this every day. All day. You guys talk to us before you make those type of decisions. Let us know. Let us know so we can advise you properly. We're managing your whole life, right? We're not just doing just your finances. We include real estate, we include taxes, your financial planning. All of that is what Thompson Wealth does. So let us do what you are paying us to do and stop making these decisions without the proper advice from a professional.
Thank you for that. Okay, so the last question in the written Ask George has to do with estate taxes, but I'm trying to read through it. It's very vague. Estate taxes for my deceased mom, what am I responsible for? I'm assuming that would be a question that they need to sit down and meet with somebody. It's a very, very broad question.
It is, but let me tell you this. That individual isn't responsible for anything because it's their mother's. You are responsible for you and yours. But if you're the executor of the estate, you have a fiduciary responsibility to do what's right. But and what that trust actually says to do. But if that person died intestate, they don't have a will or anything, no one is responsible. Now, that doesn't mean that they're not going to come after and try and get their money. That's not what I'm saying. But they can't come after you and take your personal money. They can come after anything that person's name is on.
All right. So then I don't know if you guys read through the chats in the questions in the chat while I was reading these questions, but we have a question here. Is there a way that we, the people, in order to form a more perfect union, can make a grassroots effort to demand better tax laws, such as a flat 10% tax?
I loved it.
Yeah. Wait, who said it? Who said it? Yeah. Yes. Started. Yes. I'm on board. If you can do, let me tell you what we need to do. One is the taxes. The second is, because on the calls, like when I do the investment, is anyone know how much we owe on the national debt? Like that, you let me know. So you start that one. Then we got to get one to balance the budget. Let's get that crew. And then I'm all the way up to then let's get a third crew that's going to pay down the national debt, or just you owe so much money and different things like that. But yeah, that's great. Yeah, let's grassroots effort. Let's do it.
So that means that
run on hope and change, or however you want to do it.
Amadi can run for president, and then we gon' on that platform, and then we gonna see how we can get you all up in there. If Kanye can do it, we know you can, Amadi. If he can run, you can run. Okay.
All right. Hey, I'm with it. That was really good. Hey, let me jump in here, guys, and then just share with you again. Thank you, everybody, for being in here, coming today, joining. And this helps me a lot because I see from the questions that this is also something that's very needed. So I just want to let you guys know just a couple of things that we do, just so you can kind of see it right in front of you. So like your taxes is that we want to sit down and look at your entire situation. So can everybody hold up 5 fingers? Number 1, look at your income plan. You know what I mean? Like, hey, where's your income come from? What's your income plan? Then we want to have 2 is a debt plan. I look at what people were saying here. There's all about income, where you have business, your income you have. You also receive bonuses and stuff on your jobs. Maybe there may be raises in your job. There also may be other side hustles, other things that you're doing. Income. Second is a debt plan. And then the third is, listen to this, an investment plan that does the whole, let's say stocks, bonds, mutual funds, all of that. And then that's part A, and part B is real estate. We want you to have a second, this is number 3, part B of that is a real estate plan. So we have to do that. And then the 4th is a tax plan. So we want to make sure that we have that with you, and we're having a tax plan and a protection plan. That means taxes and insurance. So we're working that plan. And the fifth, does everybody know what the fifth is? The fifth is an estate plan. So we want to make sure we have all of those in line. And if you don't have all of those in line, please feel free to send an email or send a message to Shayna, Julianne, or also let us know. We'd be more than happy. Also, we're going to put our email in the chat if it's not already in there, that you're able to respond to that we're going to do that. And then now also, Danette, if you can help me out with this and remember this. So I did a session that we're going to email to you, but then also you can go to my website at georgebthompson.com. Say that again, georgebthompson.com. And I want to tell you a couple of them. Number one, I did something called Don't Sell Grandma's House. I'm going to repeat it 3 times. Don't sell Grandma's house. Don't sell Grandma's house. And I showed a property that went for sale in Inglewood for $499,500. That was 1,000 square foot on a 6,000 square foot lot. And I'm showing, and it was in a very bad condition. And I showed everybody how you should have bought that property and just, if you had money to renovate it, renovate it. If you didn't, just renovate it a little bit at a time. But like, to me, I would have knocked the garage down and built a duplex on there and then put parking in between. And I outlined how to do that, how to invest in properties. Second, and then let me know if there's anything else I'm missing. Second is I'm going to be doing one on taxes, about taxes. It's a little deeper dive into opening up corporations and LLCs, different things like that. I'll be doing that in the future, and we'll let you know if you want the dates and times of that. And is there any other ones that I'm doing that are very apropos right now? And then also, I believe also me and Crystal are about to do one about just getting your plans together in the area of finance. Then anything else I'm missing?
No, basically, I'll say it another way. So every Tuesday, you guys at 7 p.m. look at Set for Life. And if you miss it, go to georgebthompson.com and you will be able to see the replay there. And all of the replays are going to be there, as well as this replay for this episode. If you missed some of it, or I saw some of you guys logged in a little later, if you want to catch it from the beginning, it should be up within a week's time usually, so that you can also catch those. In the past, we haven't been able to record it and send it to you, or record it so you can hear it again or send you the slides. But now we will be able to provide the replay for you all at georgebthompson.com. So you can always go there and check and see what our playlist looks like. But if you want to watch it live online, Tuesday night at 7 o'clock, join us. We are chatting it up just like we're doing right now, but it's on Facebook Live, faithfulcentral.com. George B. Thompson is not live, but you can watch it online live at Facebook
And YouTube. That was
YouTube,
great. Perfect.
yeah.
Gotcha. Okay, cool. So, and then also all clients, as you know, our website is thompsonwm.com. That's our one also for just getting information. So now everybody knows how to contact us in that area. So, hey, I want to thank everybody for joining. And I have one more thing also too, is that we did a state of the markets where I talked about what's going on with the markets. And I told you what the challenges were and what the positive were. And the challenges were inflation, interest rates, and geopolitical risks. So you're seeing a lot of those things happening now. So in the wars and different things. So you can also watch that on, you can also look at that as well. We'll send that to you, or I'm sorry, that's on George B. Thompson as well. Okay. So I'm going to stick around, but but if anybody has any other, but you are free to sign off. But anyway, thank you everybody for joining us.